There are enough narratives playing out on the market at the moment that investors continue to ask, is this the beginning of a crash? Is this pullback going to eventuate into something bigger? And realistically, should we be scared? If we just have a look at some of those high-level narratives that are really unfolding at the moment on global markets, from geopolitical tensions in Ukraine to the inflation discussion after one of the hottest US CPI prints in recent memory. Rising interest rate narrative, we know the taper's beginning for quantitative easing, but of course rate hikes look like they'll be coming sooner than initially forecasted. Supply chain bottlenecks have still not eased yet. And of course, the ultra-loose monetary policy is beginning to fade. This puts us in quite a precarious and a fascinating position. As you can see on the right, the flagship S&P 500 index continues to search for direction. We had quite a steep sell-off over the past period, where most of the benchmark indexes around the world entered into correction territory. And everybody's asking what happens now. I know there's so much fear at the moment anywhere you look, whether it's on YouTube videos, publications, different news articles. It seems like there's so much fear and uncertainty and doubt at the moment. But I thought it would be worth us to just have a bit of a step back, have a bit of a logical and objective view, think about the current bull and bearish cases out there, what are the positive and negative situations on the market, and hopefully insert a bit of a logic into this discussion, because it can be very easy to feed into the near negativity and fear, and of course that only sows more and more doubt. If you do enjoy this video, don't forget to hit the like button, make sure you've subscribed and turn your bell notifications on. We'd love to have you join the community with daily videos. And so as we discussed, there really is negative headlines anywhere you look. At the moment, just over the past week, these were some of the key headlines that have come out. But of course, there have been many more. And each of these have contributed to an underlying uncertainty. And as we know, markets dislike uncertainty. Of course, we've come out of the past 2 years that it's basically been one-way traffic. There's been linear moves upwards out of those March lows in 2020, and eventually a pullback was necessary. We've of course seen significant uplifts across a broad-based index level rally, and now the question is, have we started to get a bit ahead of ourselves? And it has seemed like we've needed to take a bit of the froth out of the market. Of course, despite these negative headlines, as we'll talk about later on in this video, there's another visual that shows there is always times to sell off, but we'll leave that for later on. I thought it would be worth us just having a bit of a look at some of these headlines at the moment, and what's really driving this uncertainty. Having a look at the Fear and Greed Index that I know many people are familiar with, if we just have a look at it on a 1 month's comp basis, we can see here, just 1 month ago, we're around 60 level of greed. So of course the markets are green, there was a lot of enthusiasm. There's a red hot start to the year. This was just before the sell-off as well. But now we're reaching into the fear stage. Not quite extreme fear, we're not at the bottoming out period, but there is quite a bit of fear at the moment. And if you talk to anyone, there's a lot of discussions about, oh, I'm not sure whether I'm going to put money into the market, I might wait, could we go lower? Is this the start of a broader based correction? Is this the beginning of the crash? Have we peaked and topped? And so there is that fear really underlying a lot of decisions and thoughts on the market. Of course, the inflation and interest rate narrative has still really been one of the key drivers. Inflation, recent US CPI print, 7.5%, the hottest print in 40 years. Core inflation, excluding, of course, energy and food prices, has pushed through that 6% mark. And of course, this is now flowing through to the potential need to raise interest rates. That's what the market's starting to price in. We, of course, have this March period as the first interest rate hike. It's a better than 95% period, but what started to flow through is the need for further rate hikes. Initially, there was potentially 3 on the dot plots. Then we got 4, then we had 5. And just recently, Goldman Sachs, one of the leading investment banks, came out and stated that they may anticipate up to 7 rate hikes this year. And this was all before the emergency Fed meeting that's just been called. And then building on top of all of that in terms of a nearer, shorter term catalyst as well, the geopolitical tensions. Of course, we've heard about the Ukraine uncertainty playing out. There's been no official moves at the moment, but we do know that the market's disliking uncertainty, and of course, the uncertainty that conflict could bring, that could have significant implications not only at a humanitarian level, which of course is the first and foremost focus, but also could flow through to global economies as well. I'm very keen to know your thoughts on it all, how you think markets are positioned at the moment, where do you think we head from here, and what your general thoughts are for what the rest of 2022 might look like moving forward. And so I do think it is worth noting that despite the fears, despite the negative headlines, it's not all doom and gloom. It can be very easy to get into those filter bubbles or those echo chambers where you're just thinking, oh no, we're going down, it's going to be the end of this, we're going into a crash, this is the long-awaited end of the bull cycle and we're going to have a 5-year bear market ahead of us. And this isn't a discussion to say we are or aren't going to have this period. There is, of course, the counter discussion that markets have been elevated for long periods of time. There's been ultra loose monetary policy. We've got record low interest rates. There's not a lot of optionality or movements at the moment for central banks around the world. But this isn't a discussion about that. I think this is just more a broad-based objective discussion about the fact that the markets are always a balance of probabilities. It doesn't really benefit anyone's investing thesis to just get stuck thinking about one negative or one positive side. I think it's always worth having a discussion about the balance of probabilities. Every investor, every analyst, every economist is going to weight those probabilities differently depending on their worldview, their assumptions, and the way they view the markets. But it is worth thinking about both sides of the coin. So I think there's plenty of good out there as well. Firstly, we're in the midst of earnings season. Using the S&P 500 earnings as a proxy for global growth and sentiment, we've got over 3/4 of the reports so far that have beat expectations, which is about in line with the long-run average. Firms have indicated pricing power as well, which shows the strength of the consumer. Of course, that's an indication that they have the ability to pass on rising input costs, rising raw materials, and really pass on any labour shortage wage increases that may have been coming up over this past period. It is worth noting that a lot of the reports and updates have highlighted the supply chain and logistics bottlenecks, which have contributed to rising costs, and obviously that affects profitability. But it is worth noting that, obviously contingent on things normalising over this next year, that these are going to be shorter term concerns. Building onto that, the supply chains. The hope is and the thoughts are that these will eventually ease. That, of course, the majority of this inflation has been driven as a supply side concern rather than a demand side concern at the moment. We haven't started to see that wage price spiral really pick up pace yet. So as a result of that, hoping that as supply chain bottlenecks start to ease, as mobility restrictions end and borders open up, then hopefully inflation will start to moderate naturally by itself. Obviously, with the Omicron variant fading as well, it means that the concerns and the bottlenecks that we've had for labour shortages and workers not being able to get to the jobs, those should start to fade as well. And then obviously demand should hopefully stay strong as we continue to open up, because the strength of consumers around the world has been very resilient. And I think this really builds into the third point here, which is the reason we're raising interest rates, the reason why there's so much focus about inflation is we have a strong economy. It is probably far stronger than the vast majority of forecasters and economists would have given credence to if we think back to March, April, May 2020. Of course, there was concerns about what was going to happen to long-term growth. Was this going to be serious concerns? Would we be in lockdown for years? Nobody really knew. We've still got a solid household savings rate. Granted, as we open up, consumers will start to eat into that. We are seeing a transition from a goods-based to a service-oriented economy, which is going to be different benefits for a range of different sectors as well. We've obviously seen the excitement in the travel sector over this past period with the opening up in Australia forecasted for the next few weeks. Demand is still there. It is just currently predominantly a supply issue, which is what most of the forecasters and analysts are hypothesizing. And what really central banks around the world are hoping for and waiting to see flow through is that wages growth will start to catch up. Obviously, there's been negative real wages growth over this past period with elevated inflation, but the hope is that wages growth will start to flow through from there. However, of course, we've got to be fair on the negative side as well. We have talked about a few of these already, but geopolitical tensions. Any news of a conflict, if an invasion or outbreak does happen in Ukraine, there's no doubt that could drive at least short-term volatility and could flow through for further implications. The energy sector is one that's definitely going to be more prone to uplifts or sell-offs depending on what plays out there. And we know the markets dislike uncertainty, so if this hangs over the market for the next period, it could be some resistance overhead. In terms of inflation itself, we know that inflation's running hotter, but a lot of this will be contingent on the supply chains beginning to ease and whether that can lead to a natural moderation of interest rates. Of course, the Fed and other central banks around the world do want to be seen to be acting towards inflation, and they will be. As mentioned, this March period looks like it could be that first interest rate rise at the next FOMC meeting. But there is currently the taper in terms of quantitative easing. The balance sheet, of course, is still being added to over this period, but that's starting to be tapered down. There has been discussions as well about QT and the unwinding of the balance sheet. So all of these proactive moves will be interesting to see how they affect market sentiment surrounding this. On an Australian front as well, it is worth noting that Australian inflation is now at the RBA target level, even for their preferred measure of trimmed mean inflation. So it's going to be interesting to see what happens at that Australian level as well. And then finally, interest rates. They're rising on the strength of the economy. markets can raise into a rate cycle, as we've seen in history, though of course those previous rate cycles had not been at a time of record inflation, and so this is going to be more interesting. But it is worth noting as well that the markets seem to be pricing in a far more hawkish Fed. Definitely the level of hawkishness that it's been pricing in, as we can see through the bond yields over just the past few weeks, has continued rising and rising and rising. And so if we do see an easing in the supply chains, this actually may have some built-in optionality for the Federal Reserve and other central banks, that if they don't need to be as hawkish as anticipated, if the economy starts normalizing by itself, this actually may give them some optionality, which could be seen positively in the view of consumers as well as investors. This is a very fascinating period. If you have enjoyed the video, don't forget to hit the like button. Make sure you've subscribed and turn your bell notifications on. Feel free to share it out as well. And I think what's most worth noting as well is the valuations discussion. All of this feeds into valuations. We know that we've had elevated valuations over this past period, really driven by the Tina thesis. There is no alternative. Obviously, we know that when you've got record low interest rates, you're not getting a lot for putting your money into your bank with your general savings rate. There's not a lot of alternatives. So this bids up other asset types, such as the stock market, such as the housing market as well, particularly when this is coupled with excess liquidity. But as we see rates beginning to start to rise, we do know that we're far ahead of the long-term average in terms of index level valuations. So it's going to be interesting to see how these normalize. Though it is worth noting, if you just look at some of these mega cap technology names in particular, thinking about names like Meta as well as Alphabet, these names are just on conventional valuation metrics. When you're looking at forward PEs, looking at price to sales ratios, these are not looking extremely expensive by any real metric. So it's going to be fascinating to see how investors start to weigh these balances up in terms of the long run averages of the broader index level, but also looking at individual opportunities as we move towards much more of a stock pickers market. We've looked into a range of different companies over this past period and done plenty of different videos looking into the broader macroeconomic space. So we'll leave links to those up above. And a reminder, I'm just a bloke on the internet who loves talking about markets. Obviously not a financial advisor, so nothing we talk about's financial advice. Hopefully it is an interesting starting spot for you to do your own research from. Let us know your thoughts on it all. Drop in a comment below. Thank you so much for joining us. For now, stay well and happy investing.